let's have a look at third company. Okay, if we started to look at balance sheets, so let's have a look at KFY. Okay, great. Now, the difference between KFI and RHI, first of all, it's smaller company. It's only 1.2 billion capitalization compared with the RHI, which is 5 billion capitalization. It has debt, 270 million, so it comes about 22% on the debt level. Now, it's also was affected in 2008, same as RHI. Okay, we can see that the sales dropped from 15 $18 on the highest level in 2007 to $13. So they lost about 50% in sales, but their profit, their net income, dropped about 4 times, right? But good thing to see that that particular company didn't lose money, same as RHI. If we look at RHI back, so we can see that also in 2008 their profit dropped from 163 to 24 cents, but they still were making money, and their sales level dropped 50% as well. Okay, so it's a good thing to know that these companies they manage to readjust their expenses, and probably they lay off some stuff, and after that they kind of reemploy them when the economy improves. Okay, so but we understand that that's how economy affects these particular companies. So we can see here that since that moment, company from 2009, constant sales growth. We can see sales always was growing, but if we look at the earnings, first year after 2009, 2010 had a huge gap in earnings, like jumped up. But then 2 years was kind of going down, and then again growth. So that's why when we look at the table and insert in TACN table, we can see that it's gets only 1 point here because it's 2 years. Within 5 years, company weren't growing. And actually, if we look at the current year, we can see that it's from 2008, from $2.08, it's planning to get to $2.10. So it's practically flat. There is no growth here. That's why the price went from $38 to $18 at the lowest level. So it's like 50% loss. Okay, and we can see that now price earning ratio 9.9. Interesting thing about it, then if you look at 9, price earning 9, I was really confused myself here because I'll show you why. Now, average price earning ratio for this particular company is around 15. Okay, whereas if you look at Robert Half, it was 21, right, average. Now we're going to look what's the average here, but we can see that this company has lower price earning ratio historically than RHI, and I presume the reason for that the rate of growth was smaller. It's first thing, and secondly because it's smaller company. So people understand the risk of smaller companies, and that's why they are not happy to pay more. Although, if you look at this on assignment, uh, their earnings higher and their price earning ratio is much higher as well. Okay, this company, as I said, has debt, but also it pays dividends. So in this particular case, now book value, that's kind of a lot of people I know, like a few of my friends investors, they said, oh, they would invest straight away to this company because it has $20 price right now and it has book value of $90, and they see it like a secure because assets is $19, so it means it's already kind of no way to go lower. But that's where it comes goodwill. So and I always go to goodwill. Okay, if we open the balance sheet, we can see that it has goodwill of $590 million and then $233 million of intangible assets. So, and then if we deduct liabilities which they have, so we can see that total shareholders equity, including goodwill, it's 1 billion and 45 million. But when you deduct these intangible assets, it's only become 222 million. So it's like 20% of that. You understand such a huge difference. So if we go back to value line report and look at this 20% out of it, it would be only what? About $4. So it's much lower than the current price. So that's why this book value is not going to work as a protection for this particular company. Now, if they could convert this goodwill and those intangible assets into cash, that could be okay. But because they cannot do it, it cannot be considered like a protection from this point of view. But at the same time, price earning ratio in value line report is pretty low, and that's where my confusion comes because during our meeting uh, we look at this that KFY, if you go, for example, here, all right, Yahoo Finance and summary, we will see very interesting thing that price earning ratio is 103. To be honest, I try to find the way why it's happening, why price earning ratio right now is 103. I couldn't find it. And the same story on FinViz. When I looked at FinViz, it was even higher there, 119. And I looked at their reports. They have 56 cents steadily reports. So to be honest, I don't understand why, uh, like Yahoo Finance and FinViz, they show in uh, price earning ratio 103. So if somebody of you will find it, if somebody will find it, please let me know. I will be really, really curious to find out why uh, is it happening. Okay, but interesting. It also gives me very good understanding that uh, of why sometimes it's difficult to find companies which are in a good position because if you make a screen on FinViz, they will miss these companies. So if, for example, you put price earning ratio uh, below 15, right, you won't be able to find this company. Now, if you screen, it's better to put future price earning ratio as a screening because if you look at future price earning ratio, all these companies they show that it's below 10. Okay, so all of them they are telling that this company is undervalued right now based on future price earning ratio. Okay, because usually company above 10, like 15 or close to 20 even price earning ratio, and if company future price earning ratio is 8, it means that within next year it has to grow up. Okay, that's from Korn and Ferry International. So if we go to TACN table, so what we can see here from quality perspective, again, it's losing on industry rank, and timeliness it's 4. So it's value line doesn't believe that these companies will grow within next 12 months faster than other companies. Okay, always understand that this is comparison. So they still can be growing, but not as fast as some companies with the timeliness 1. Okay, safety is 3. RHI, remember, it was 2. And we can see here it was a debt, so it's losing on debt, so 22%. The growth rate in the future is slowing down. That's what they see, and that's why they get 3 points here. Altogether, it's 33 points. So this company doesn't have as good quality as RHI has, right? But from price perspective, it's also undervalued. Okay, and if we can see that based on TACN valuation, and we look again at highest price earning ratio and lowest price earning ratio, we'll see that sometimes in the future, based on the historical evaluation and multiples, right, it can go to $54 based on their projection of $3. So if they tell us that they're going to make $3 in the future and they have the highest price earning ratio, which is 18, right? So they might go to $54 in price. Now, if they keep the same type of income, which is $2.08 for the future, and get to the lowest price earning ratio, 11, they might be 23. But we know that right now, price earning ratio is already 9.9. So that's why the price is not 23, it's around $20. So it shows us that this company has a much better potential for growth as well than their competitors, for example, like on assignment. Okay, so these two companies, RHI and KFY, they have a potential to grow. Now, if RHI has earnings tomorrow morning, uh, Korn Ferry, they had recently earnings. Okay, not as far ago, and so you kind of, if you do trades with this company, so you won't see any news coming up like from the company itself. Of course, there could be some news from different other companies, and I'm going to show you how it can affect the price of the